Welcome back. We have Gareth Soloway, Chief Market Strategist of In the Money Stocks with us today. Gareth, how you doing?
I'm doing well. Busy, but doing well. Thank you, Greg.
Yeah. I appreciate you taking time out on this monumental day. And, just for everybody watching, our thoughts and prayers go out with the people of Ukraine, as well as the people of Russia that have no part in this, did not want anything to do with this. We're thinking about you. We're with you. And hopefully we can put this thing behind us here soon. But unfortunately, I think there's a little bit more yet to come.
Yeah, it certainly seems like it. And honestly, I was a little surprised. It made sense that Putin took over those territories with the separatists in them. I understood that, but this is definitely taking it to a new level. And it's sad because, as a trader, right? I mean, we're taught to buy when, and it's a term that means a lot more, but when there's blood in the streets, right? And then you think that in actuality, there is that in Ukraine and it's heart wrenching, it stinks. I hate bullies. I really do.
Yeah, it's very, very unfortunate. And, obviously we know what Putin's agenda is, and I don't think he's going to stop until he achieves it or somebody stops him. So hopefully it won't escalate out of control into a whole world war situation. And, but anyways, it's tense times and markets are reacting. And, our job is to help investors out there. And especially if there's people in Ukraine and Russia that need to protect their assets and understand the market and the climate and what's going on in the next move. So let's go ahead and dig in and take a look at what you're seeing. I know we had a big flush last night, had a little bit of a rebound today. So what's going on?
Yeah. So, I mean, showing my S&P chart is you got to be impressed with the recovery today, folks. And again, it seems like Biden's speech gave the market a little extra push. We were already rallying off the lows earlier today. I did do buying this morning pre-market. I was buying like crazy because, again, if there's one thing I've learned in my career is that when there's panic out there, that's usually when there's opportunity as well. So in the overnight, I had limit orders out for some cryptocurrencies. Some of them got filled, not all of them. And then same thing this morning. I was when the pre-market was open here, I was buying. So, I added to some Facebook, near 190. I think that's back closing in on 205 and some other ones as well. But you can see this reversal here. I mean, incredible reversal in the S&P going green on the day now. And that's after we were down, well over 2% at the lows. Do I think the selling is over? No. I think this is a short-term reprieve. I think things have gotten too bearish, so you have some short covering. And I think ultimately the markets maybe have a week or so of bounce in them. But I do think that, again, we're far from over. If the Fed is really going to stick to it, then you have to come back in this longer S&P range here, which is basically removing this kind of steroidal push on the markets that occurred when all the monetary policy was put into effect during COVID.
Yeah. And, I think on that note, the Fed, they have to stay the course. In fact, they might have to come out a little bit stronger than they initially anticipated because of the situation now with energy costs going up. This is going to add to inflation. We are seeing slowing growth out there with some of the leading indicators with PMIs and things like that. So it'll be interesting to see what they do. But I think they're going to have to come out with at least a half a point. I don't think markets believe they're going to do that. And we will probably see at least another 10% haircut.
I was going to say too is, and here's the NASDAQ 100, and that's actually ripping today. One of the things I thought about this morning, I tweeted about it early this morning, was that does Russia going into Ukraine and the geopolitical issues, does that maybe pull the Fed back from tightening, 2 times, essentially doing 2 rate hikes or a half basis point at their next meeting in March? And is that positive then for technology? And at the time with this, the Qs were below 320, but the idea being is that maybe in a weird, perverse way, this is a positive thing if it gets the Fed to slow down on their rate hikes. I don't know,
It'll be hard to say. We have a CPI print coming out before their meeting. So if that is very strong once again, then that gives them even more argument to stay the course and to be aggressive. And a lot of it's going to depend on how this situation escalates once we get there. But I tell you, the other thing it can provide the opportunity for the Fed to do is unload their balance sheet, because people are looking for safe haven assets right now, and really aren't any out there besides cash.
That's right. And I think the Fed has to, hopefully they take advantage. I think one of the things I've been disappointed in the Fed for a long, long time is that they always are late to the punch, right? So whether it was, with tightening, they should have started it way earlier and then they could have gone slower before inflation got out of control. But here they have another opportunity. The question is, are they taking advantage of it? And hopefully they are, like you're saying.
Yeah, they have to do something. There's a flight to safety right now. It'd be a perfect opportunity to do it. They could probably unload half their balance sheet pretty easily without affecting rates and keeping rates lower. So, it'll be interesting to see what they end up doing. Where are you looking in NASDAQ right now? Because we are seeing a lot of the tech stocks snap back. What are your thoughts on FANG? Do you think it's over? Do you think it's a complete new market for those and a repricing and they're going to continue down? What are your thoughts?
Yeah, so I think in the short term there's a reprieve, right? So looking at the Apple chart, you can see that this major trend line did get tagged at the opening bell today. So again, this is a long-term trend line that goes back to 2020, and again we've hit it now again. So I think this trend line does break, and one of my theories for how the NASDAQ will continue lower is that you'll see these big cap tech actually start to take the lead to the downside. So eventually I think it does come down, but it doesn't mean we won't bounce. I mean, Apple's now turning green on the day. I think we could easily go back on Apple to 167 before it kind of stalls out. There's a gap fill right up there. But once this line breaks, that's problematic for Apple, because now you're talking about a potential move down, maybe back to this level right here. And if you go back to $100, I mean, the Qs will absolutely get slaughtered. Now, on the other side of the coin, I think there's some real opportunities. So I was mentioning I was buying Facebook today. Now, again, you can see back to 203, but I mean, huge reversal after opening around 190 this morning. Pre-market, it was even lower than that. And then I've been really—
What's your target on Facebook? I know at one point you were looking at 240, 250.
Yeah, I still think it has a shot to get back to this gap window here. That would be your first big resistance. Now, it seems a long way away at this point to get back to that, but I do think there's a chance. And again, I look at Facebook and we know that their growth has slowed a little bit. We know that, their earnings weren't as good. And really, one of the issues with Facebook is that all of a sudden people are very negative on the metaverse, right? All of a sudden people are like, oh, they'll never do it, how it's going to be running deficits in terms of earnings forever. I'm kind of in the camp that, Facebook, when they bought Instagram, everyone was like, oh, they paid $1 billion for it. They overpaid, horrible acquisition, turned out to be genius. Right. So again, I like to give Facebook the benefit of the doubt. So I think, again, if we get a decent bounce here, you could see Facebook play catch up. I think a lot of funds are now underinvested in Facebook because they unloaded so much. And I wouldn't be surprised if it starts to get some momentum. But there are other stocks out there. As much as I'm kind of skeptical on Apple, Roblox, a remarkable sell-off from $140, close to 40 this morning. And then you have stocks like SE, C Limited. This is a high growth. I think it's a Korea play, South Korea, kind of Amazon-ish and gaming play. And just, look at the blood that's been spilt on these. And again, I hate to use that term when what we're going through, what the people of Ukraine are going through, but just ridiculous types of downsides. So these are where I'm looking, right? Where the analysts have gotten overly bearish, too overly bearish. And I think there's a catch-up trade. And SoFi was one I bought, added to this one this morning. That's had a beautiful reversal. And then I'm trying to think of some of the other ones out there.
What about Netflix or PayPal? You doing anything with those?
Oh, PayPal I added to this morning. I already had a position on PayPal. I added to that this morning. Block is reporting earnings after the bell, which I also have as well. That's going to be interesting for PayPal. And again, Block is kind of a crypto play as well. So that'll be interesting to see. But certainly some of these names are really, they're beaten down to the point. I'm not looking for long-term investments here, but I'm looking for significant 20% plus bounces.
Yeah, that's what I'm thinking before we look at any more downside. Now, that's, of course, all bets are off if Russia really escalates and then really goes in and this thing gets really ugly. And then maybe they go after, who knows, any neighboring country and expands what they're trying to do, which this could be a precursor for that. But we don't know. We don't want to speculate.
One of my biggest, and this is something that I've heard a little bit mentioned, but I think it deserves to have more mention, is that this is a test. China, first of all, China clearly told them, don't do this before the Olympics are over. We know China very proper. They wanted to focus the media on the Olympics. Basically, as soon as the Olympics were over, Russia started the aggressive actions going into Ukraine. But the question I have is, Is China basically, did China goad them and say, yeah, Putin, go do it, because they want to just take a look and say, okay, well, what is the international community doing? Because we want to do this to you, to Taiwan. And I think that's where now you're kind of in a whole new ballgame. They do this to Taiwan. Well, what kind of sanctions are we really going to put on China? How much does that hurt our economy? What does it do to the global economy? Now, Russia's a big economy, but it is certainly no China. That's the bigger issue here.
It is. It is. And, those two are allies. And if they come together, then, yeah, then you have a real situation on your hands. And I think that's the real risk that's on the horizon. China's already making some moves. Taiwan's already put the flag up and said, hey, we got a problem over here. So if that develops, I think you will see complete market shock, initially, if and when reports come out about China.
Yeah, I agree. And again, it'll be interesting to see. And this is one of the reasons, and it's such a tricky scenario for the administration, is because they need to be firm on Russia to send a signal to China as well, not just to be firm on Russia, but to send a signal. But then you have all these ancillary factors like the cost of natural gas and wheat. I mean, Ukraine is a massive exporter of wheat, and so many commodities are intertwined with Russia and Ukraine, and then that adds to inflation here in the United States. So it's really a multi-layer issue here that there's really, honestly, probably no easy answer.
Yeah, and with inflation and with conflict escalating inflation, the Fed, there's nothing they can do. And even, I mean, what can they do? Rates are already zero. They're going to buy stocks to prop the market up. I mean, they can't do that. So I think at this point, the real risk is that anchor is gone and they can't step back in. Even if they say, well, QE is going to continue, we're going to leave rates low. That's not going to fix the issues that we're facing in terms of deflation and stagnation.
Yes. Yeah. And I think that's the bigger question too, is if they can't get inflation to really get back to, let's say, 2% or even 3%, and then you have all these rate increases that could potentially slow the economy, then you have an issue of stagflation, which again is far worse than just inflation with growth, right? Stagflation is inflation with zero or negative growth. And that is really detrimental. And that's kind of my scary scenario for the second half of the year, where I think, again, the markets have a lot more downside over the next 12 months, for instance, because I do believe the Fed is going to act very aggressively here. And then again, do they slow the economy, but can't get that inflation number back down?
Yeah. And this just isn't bear talk for anybody. Listen, this is, hey, here's what's going on. These are the realities of the risk that you're facing. So prepare for it, enjoy and take advantage of this potential bounce and upside, but there's more downside coming.
And I think that's important, really important point to make, Greg, is that, like I said, I mean, I'm long SoFi, I'm long Facebook, I'm long PayPal. So I've gone long here because there's shorter term opportunities, but I certainly am not going to be sitting back and waiting for new all-time highs. I'm going to be aggressive, looking for 10, 20% moves, take at least most of the money off the table. Maybe you leave a little bit out there just in case, but for the most part, I think you'll be able to get these even cheaper in 6 or 12 months from now.
Yeah. And then the real question is, once we're at that point and we have repriced, then what's the path moving forward from there?
That's right. That's the incredible thing. And you worry about scenarios like, what if inflation doesn't come down? Is it like the 70s? And then, do you get rates pushing up, and then do you get a crash in housing if rates don't stall out? I mean, imagine if we went back to a 5%, or 10 or even 10%, it was higher in the early 80s. But I mean, what does that do to housing? I mean, there's so many houses of cards built here that could come tumbling down.
Yeah. Real estate's already starting to feel the heat. That market is getting ready to shift. It's changing. I ran some numbers and did a little something on that earlier, but for the individual that has $2,000 a month to spend on a mortgage, the average mortgage out there is about $2,000 a month. At 3%, you can buy a $474,000 house. At 5% mortgage rates, that drops down to $372,000. So that's a 20% drop in housing. And that's kind of what I've been calling for, is that 4% changes behavior, which we've already seen a 13% drop in mortgage applications because rates hit 4%. 5% changes market conditions and values to the tune of about 20, 25%. And again, it's a repricing, just like we're seeing in the stock markets. If you get to 6, 7, 8% in mortgage rates, that's a 50% drop in the value of housing stock. And I'll tell you, for anybody watching that wants to buy a house, I'll tell you where the first place to look is when rates hit 5% is the national home builders that are building production and building a lot of units. They can take a haircut. They will reduce inventory, and they'll drop prices fast when the market shifts. The average retail homeowner and seller The average seller is not going to change their opinion of value, and they don't have to because they're probably in with a low rate and those types of things.
Right.
But home builders, that's the first shoe to drop, and that's where you're going to get your best deal when rates rise and the housing market shifts. So keep your eye on the builders and their inventories if you want to buy a house, and give it till probably the summer, maybe the fall, and you'll start to see some sales happening in some of these new home communities if rates
Yeah,
are
in
rising.
fact, I've been renting now since I sold our house in Oregon back in August of last year, and I've been renting here in Florida, and I've been just interested to what's available, and I've started to see for the first time housing on Zillow, for instance, prices are being dropped. You'll see a price drop $100,000. Well, and then that's in the range that I'm looking for housing, but you're starting to see it. It's just starting versus 2-3 months ago, it was 100,000 bid over asking that these houses were going for.
Yeah, you'll see price drops. You'll see for sale signs start to pop up everywhere. You'll see days on market go up. Those are your first indications. But so let's take a look at Bitcoin, crypto. And I know you said you were up at 3 a.m. Eastern Standard Time last night, trying to keep everybody updated and make some moves.
Yeah. So basically, and again, I run the crypto service, and over the last I would say since the Olympics ended, I was putting out limit orders when I would go to sleep, because if the invasion did occur, you would get these sharp drops in cryptocurrency prices, even if they generally recovered. And that's always been my policy. Same thing with stocks. These sorts of shocks are quick, and you can get good prices, but usually there's a rebound. And so far, it's been amazing. I mean, you can see, look at Bitcoin almost trading at the highs of the day here, back above 37,000. Low of the day was around 34,500. So already a rebound. But yeah, that's what I was doing here. One of the little things that I did like about Bitcoin today, and again, this is an interesting little tidbit, is that if you look and compare this chart to the NASDAQ or the S&P, this is the only chart between those three, this one and those two, that didn't make a new low, right? So if we go to the Qs, all right, Qs obviously opened way lower than their January low down here. Now we've rallied back, but still way lower. Now, if you look at the spiders, we opened lower than the January low as well, right here. One of the interesting things that you could kind of start to make a little sense of and maybe see was Bitcoin kind of a store of safety here? Not that it didn't go down, but it didn't make a new low. And again, I still think Bitcoin is a 90% risk asset, but you're starting to see those little signs that everyone is dreaming about becoming reality, where maybe there was a slight amount of buying in Bitcoin today that kept it from breaking that low from January as that store of safety, maybe a little bit in there.
Yeah, and it's starting to potentially put that macro bottom in that, last time you and I talked, I know you're still thinking there's a $20,000 price drop on the, drop to $20,000 on the table. And I'm thinking it's going to be extremely difficult to get below 29,000. And now really it's that $35,000 level.
Yeah. It seems like it. Absolutely. The low, pierced right there, which was really the low of the candles here, right in this range. You have the tails that pierced, but if you draw a line right here, kind of goes right over to that level. So I agree. And again, my case for 20 or sub 20,000 is going to be a later in the year situation, where if the Fed does see a stall, out, or causes a stall in the economy, then all of a sudden you have inflation, but people are buying less goods, meaning earnings start to tumble down for equities. And then I think that deleveraging could also play an impact in crypto, at least in the near term, and potentially seeing that .com washout, right? And again, I've talked about that before, how there's so many similarities with the .com era, with changing world technology, internet, now blockchain, and the whole .coms were about 2.9 trillion. At the height in November, it was just over 3 trillion for cryptos. I mean, so many weird scenarios. In fact, did I show you last time how if you look at the chart of this, right? So you have this kind of M-ish pattern. And then if you go to Amazon from the .com era, let me flip over to the monthly chart, weekly chart, but this is just like freaky, right? So same pattern in Amazon as Bitcoin. And then this was where the dot-com bubble topped out. You had the M pattern, and then we went from $110 down to $6 in that decline. And what I like to show people is, and this is such a cool chart too, is, don't think that I don't like Bitcoin or I'm not a fan. I'm a huge long-term bull on Bitcoin. I just think you need to flush out the crap, right? We have all these meme coins and 15,000, cryptos. There's no need for that many cryptocurrencies. And what I want to show people here is, if you went to the chart, and if we go to the monthly chart on Amazon, and let's just say that Bitcoin is the Amazon of, today, well, look at what happened after. Here's your little M top on Bitcoin back in the dot-com bubble, and then look at it today. So again, yeah, you might have to go through some pain. Maybe Bitcoin goes sub 20,000, maybe it goes 10,000, who knows? Maybe it goes to 7,000. But the idea is, if you really believe in the long-term stability of Bitcoin and what it brings to the table, look at what Amazon did after that. All right. And that's pretty cool.
Yeah. It's interesting. And, there's a different kind of investor and holder in Bitcoin than there are in stocks. I mean, some of the same investors, obviously, but there's obviously, from a retail standpoint, a different level, like a Michael Saylor kind of investor, right? He's just not going to sell unless he's forced to or has to, no matter what. So there's a certain amount of that type of investor in Bitcoin that just is not going to sell, is not going to let go, which is interesting. And obviously we saw what happened back in 2020. It dropped down to 4,500 during the pandemic. So I think when you get a serious situation and a serious economic panic out there where, we didn't know what was happening from a global economic standpoint during that time frame, this time's a little bit different. And, that's why I think that $35,000 level is interesting, and it's going to be a hard one to break. But if it does break, then yeah, all bets are off. I think your next stop is 20, and then we'll see if that holds. And I think it would take a serious event for that to happen. That would take, I don't know that even the Fed coming out hawkish is enough to break it below that $35,000 level. I think further deflation, recession, I think those are the types of things that potentially
I'm in agreement with
breakdown.
that. I think recession would be, where you saw inflation still kind of a little bit high, but really this kind of deleveraging taking effect, where the Fed can't come in and print lots of money to save the day because inflation is still high. I think that could really be that catalyst that drops the NASDAQ. Really, again, what's crazy about the NASDAQ is, as nasty as, I think at the lows today, we were down 21% on the NASDAQ. But if you zoom out, look at this chart. Just going back to pre-COVID highs, which was just in 2020, you look at how far you still have to go down. It's remarkable. So, if we did see something like that dropped us down there and we got to here on the NASDAQ, I would dare say that, I couldn't imagine Bitcoin not going lower if the NASDAQ goes down this far.
Yeah, it's been keeping step with the NASDAQ percentage-wise on drops and bumps. And, and it's different than crypto. So to your point, there's a lot of junk in the altcoin space, in the crypto space that needs to get washed out. Bitcoin's a different animal, different asset. And as you know, altcoins and other crypto assets are exponentially, going up and down exponentially compared to Bitcoin. And when Bitcoin's up, or Bitcoin's down, altcoins are exponentially going down. And sometimes when Bitcoin's up, altcoins are bleeding as well. So different animal there, and a lot of junk needs to get washed out there. You have a lot of money in the NFT space. I think a lot of those things are going to, end up at zero at some point.
Yeah. It's remarkable, the NFT situation. And again, it just, it screams people having too much money at the time, to be able to kind of throw down that type of cash for NFTs. And it's become such a big thing online now too. And yeah, just does remind me of situations like the .coms.
Well, times are good. The economy's strong. Everybody's been making money, and it's a fad. It's trendy and things like that. And when the chips fall, and if you remember 2008 and 9, what's the first thing everybody sold? Lamborghinis, Rolexes. Right. People started getting rid of those assets. Private jets. You could pick stuff up for 50 cents on the dollar after 2008 and 9. And I got a lot of phone calls from friends. Hey man, you want to buy my, Rolex? You want to buy my boat? And I was like, no, I don't want a boat.
Yeah, you don't want that headache.
Yeah, exactly. In my area, it was a lot of boats, man. There were a lot of boats for sale 2008 and 9.
Nice. Yeah. It is an interesting time. It's to think about how the market was so controlled by the Fed, and, we'd have, how many times did we have just 3% corrections and then it would just go right back to new all-time highs for like the longest time in history? I think we hadn't had a full-on 10% drop. And then, you kind of break out of that. And I think that's important to note, is how the charts kind of guide you in that way. Like here's this S&P 500, right? And going all the way back here. And then once we broke here, I mean, this is really where the volatility kicks in because you broke your trend, right? Your trend has now been broken. Your uptrend is now done.
Yep. And the real question is, so I guess those lines that you've drawn down there, I mean, you think that we're going to get down and touch those?
Yeah, I think that if the Fed is really truthful in terms of at least going back to pre-COVID balance sheet and all these other things, then I think it makes sense that we would go back to the longer trend, right? And again, maybe in the upper range, who knows? I'm kind of not biased, but I kind of think like there's probably at certain point where we have to retest that pre-COVID high. And then, yeah, I mean, at that point, the big question is, right? I mean, this just takes you back to 1 to 2% GDP growth, right? What if the Fed pushes us into recession? I mean, then, and what if they can't print us out? I mean, do we run the risk of a 1929 type scenario? I don't know. And again, I think it's important as investors. You don't have to, you don't want to base all your decisions on one fear, but you have to take it into account when you're doing your risk assessment for what you're investing in.
Yeah. And I think, a lot of people have forgotten that, those pre-COVID levels were pretty frothy levels already.
Yeah.
And QE driven.
Yeah. I mean, and that's the important thing, right? Is that this was all QE in here. I mean, there was just nonstop. In 2018, remember, they tried to withdraw it and we got a 20% drop in 6 weeks in the markets. And then they backed right off and started printing again. So, I mean, you're just going back to pre-COVID printing levels. It's not even like you're removing it all from the system. Yeah.
Yeah. And we haven't hit, 20% yet in the last couple of weeks. As much damage has been done in the markets. I mean, the NASDAQ was the worst. And I think that was close to almost 16, 17% at the lows.
Yeah. I think today at the gap down, I was hearing on CNBC, they said 21%, but again, I didn't confirm that, but I thought I heard that. But obviously now we're now positive by a decent margin. I think we're up almost 2% on the NASDAQ.
Yeah. Snap back nicely. So awesome. Well, Gareth, I appreciate you taking out a few minutes today and helping us update everybody and what to look out for. And I look forward to getting together again here soon.
Yeah, thank you so much. I love chatting with you. I think it's great for the viewers and the listeners. And yeah, I look forward to coming back on soon.
Awesome. Well, take care of yourself. Be safe out there, and I'll see you on the next video.
Thank you so much.